Really, to give you a brief overview of what we'll be covering tonight is a comparison of residential real estate investment in Singapore and the UK. And what I have found over the years is that very often the perceived barrier to entering in an overseas market is the fear of the unknown. Naturally, if we live in Singapore, we know Singapore, we can go see a property, we can ask friends, we can ask real estate agents, and hopefully get a fairly confident understanding of the market of whether it's a right investment. When investing overseas, then if you've not traveled there or lived there before, then educating and finding out and being confident that this is the right place to invest can very often scare people off. And I see as part of my role the ability to share with you, educate you, and take you on a journey so that you can make well-informed decisions of whether it would be better to invest your hard-earned cash in Singapore real estate, or in this case, in UK real estate. Now, you should be able to see a chat box towards the bottom right-hand side of your screen. We will be having a Q&A at the end of the presentation. So if you have any questions, please jot them down in the chat box, and at the end of the presentation, then I'll be more than happy to do my best to answer. So let's get stuck into the presentation tonight. And I really just wanted to start off by sharing some of the recent trends that have impacted the property markets over the last few years. And typically, this isn't just in Singapore or the UK, it's very much in many countries around the world. And what we've seen in the last couple of years is significant inflation pushing up prices. And one of the main ways that governments have tried to curb and get the inflation under control is using interest rates to slow the rate of growth and hopefully bring down the overall prices of things and goods in that country. To give you an indication, the UK, was hovering for a long time around about 2 to 3% inflation. At its worst, in the last couple of years, it went to just over 10% inflation, but now is back down to close to 2% inflation. Now, with the increase in interest rates, mortgages and financing became more expensive, and for many people, it became unaffordable to be able to take out a mortgage. But of course, somebody still needs to live somewhere, and so they were forced to rent. And what we found is through people being pushed into renting property, plus a slowdown in the build of property, increase in interest rates, material costs, labor shortage, planning consents taking a long time in the UK. With this overall shortage and more people having to be pushed into rent, we saw rents going up quite significantly across the UK in the last couple of years as well. We've seen similar things in Singapore. In fact, when looking at the data in the last sort of 3 years or so, rents have gone up in the private sector by actually just over 50%. So a phenomenal growth of rentals to the point where it really has been an issue, and people sometimes having to consider whether they will stay in Singapore because the rents have just become astronomical in areas. With a lack of new build supply, this has helped to keep prices increasing, even in light of higher mortgage interest rates. It was thought that as interest rates increased, that property prices both in Singapore and the UK would actually decrease. But interestingly enough, in both countries, we've seen property prices continue to increase, although in the UK at a much slower rate. So with both countries also having new prime ministers, it's kind of, I suppose, a breath of fresh air in some respects. In the UK, not only a new prime minister, but a new Labour government, the first time in many years that they've come to power. Just one of their mandates is to build 1.5 million homes in the UK over the next 4 years, which I think is going to be a very challenging target when you look at some of the data that I present a little bit later. The UK has recently cut the Bank of England base rate for the first time in several years from 5.25%. Now, to put this into context, just over 2 years ago, the Bank of England base rate was at a 300-year low at just 0.1%. So we can see that interest rates did increase quite significantly at quite a fast pace, but it does look like we're starting to turn a corner. And as I say, the first rate reduction in the last few years. As a result, UK lenders are starting to reduce their mortgage rates, and with early signs of buyers returning to the market and with a huge undersupply, this could see strong growth over the next few years. So it's an interesting time in the UK property market. So let's look at some data, because what I want to do is present data so that we can try to do our best to interpret the data to make meaningful decisions on, again, where is best to invest. Now, this is a chart showing the last 10-year FX exchange rate between the pound sterling and the Sing dollar. At the moment, this was done a couple of days ago, and it's just over 1.7 Singapore dollars to the pound. In fact, since 2016, it's hovered more or less between about 1.6 to 1.8 and probably averaging at about 1.7. So it's been relatively stable. There was a sudden change in December, around about October, November of 2022, when Liz Truss had a mini budget, and literally for about a week, the pound fell to 1.5 Singapore dollars. 1 pound to 1.5 Singapore dollars. But actually, if we go back a bit further, when I first arrived in Singapore, the exchange rate in July 1995 was about 2.6 Singapore dollars to the pound. In fact, I remember selling a property in the UK in 2007, and the exchange rate then was 3.15. So we can see at today's exchange rate, it's almost 50% stronger in favor of the Sing dollar compared with what it was in 2007. And even when we go back to just prior to the Brexit referendum, where in 2015 the Sing dollar was at about 2.2 Sing dollars to the pound, I think the overall message here is that the Sing dollar is still a very strong currency against the pound sterling. It's almost like getting a 20-30% discount compared with what we can see some years ago. So you could argue to say, well, investing into an asset into pound sterling is very, if you're holding Singapore dollars, which I imagine most of our people dialing today are from Singapore. So again, we've got a very strong Singapore dollar. Whether the pound sterling does come back, we'll see. Sometimes with the new government, there is a temporary strengthening of the pound sterling as there is renewed optimism with the new government in. But again, let's watch this space and see what happens. So let's look at the different ways of tenure and leaseholds between the two countries. So typically, Singapore has a minimum 99-year lease for residential property. It can go up as high as 99 years. And for some properties which were provided with a freehold, then generally speaking, those plots of land stay as freehold unless they are converted to a leasehold. In the UK, for most apartments, the minimum leasehold is 125 years. The maximum is 999 years. And you find that with most landed properties, they are freehold. Now, in Singapore, it doesn't allow a leasehold top-up after 99 years. So in effect, the land goes back to the government. However, in the UK, it does allow leasehold property top-up, so it can be extended. Now, owning property through a company is possible in both countries. Although I must say, as we go through the presentation tonight, you will see that there are some very high stamp duty rates for owning property in company structures. In the UK, though, it's possible to invest in a company structure. It's now through a company that has created a online platform to make it far quicker to set up. It's more cost effective, with numerous tax time efficiencies and sales advantages. Now, this is a whole presentation in itself, but again, it's worth considering if you are going to be investing. Should I invest in my personal name, or should I do it through a company structure? Several years back, if buying a property which was a lower ticket price point, the actual cost of setting up and running a company probably didn't make it commercially viable, whereas this platform now makes it very, very viable, even for a property costing £100,000 or £200,000. Now, this slide actually comes from DBS, and I found it very interesting because it tracks basically the breakdown of people's investment portfolios based on the asset class. And we can see in the dark red, which is showing a percentage of the somebody's net worth in property. In 2001, it was just under 52%. In 2011, it was just under 50%. And although it has gone down in 2021 to just under 42%, it still presents by far the most significant asset class in people's investment portfolios living here in Singapore. So I think the takeaway here is that people living in Singapore do like real estate and have a significant amount of their net worth tied up in property. Now, let's compare some of mortgage differences and options between the two countries. So one of the interesting differences is in the UK, you can get what we call interest-only mortgages. Now, that means if you take a mortgage out, you're only servicing the interest of that property. You're not paying down any of the principal. And what that means is that the amount that you're servicing on a monthly basis is much smaller. So typically, you are getting a more positive cash flow. And I suppose part of the argument is that if it is an investment property that you're never going to live in, over time, the value of that property will go up. And when you sell it, basically, you'll make a capital gain. And what you'll do is pay back the balance of the mortgage to the bank, but you will have had a nice positive cash flow, hopefully, along the way. Now, if you're buying a property that is your primary residence and that you don't want to be having a burden in later life of still having to service a mortgage because you haven't paid down principal, then I would think in most cases, taking a mortgage that is both a principal and interest, so that at some point, especially by the time you're in retirement, you're not still having to service a mortgage. So as a general guideline, what we find is that if it's your primary residence, most people will take a principal and interest. But if there is an option for an interest-only mortgage, these are very popular for investment property that you're not going to necessarily live in. Now, in the UK, loan to values can be up to 75%. In fact, on occasions, I've even seen up to 80% loan to values. Interest rates, because they're still on the higher side, and these are based on foreigners investing into the UK or non-residents. So I'm a Brit, but I'm a non-resident. So I'd be looking at somewhere between 5 to 7.5% interest rates at the moment. In the UK, there is no TDSR or total debt service ratio. So you can, in theory, take as many loans as the banks will give to you. It's not restricted. Now, mortgage is required upon completion. Now, one of the things to be aware of in the UK is if you're buying a property off plan, let's say it completes or TOPs in 1 or 2 years' time, the developer will be asking you, once you've paid your booking fee, usually within a month or two, you're having to sign a sales and purchase agreement. So you're legally binding yourself. Now, you can get an approval in principle from a mortgage broker, but that's not an actual mortgage offer. In the UK, you can only get a formal mortgage offer typically 3 to 6 months before the property is completed. And so you do have something called mortgage risk. It means that if you are buying off plan and you are not getting a mortgage at the time of signing a sales and purchase agreement, you are committing to buying that property, even though you're not 100% confirmed of being able to have a mortgage. So if that's something that is too risky for you, then typically what I've shared with clients is, well, either buy a property that's close to completion or is actually completed, and at the same time as doing the conveyancing and signing a sales and purchase agreement, in tandem, you are applying for a mortgage as well, and that you will only sign the sales and purchase agreement upon getting a formal mortgage offer. Now, in Singapore, there aren't interest-only mortgages, so you're basically paying principal and interest, which does mean that you're servicing as a percentage a higher monthly mortgage payment, and that will typically reduce your cash flow, and it might even mean that your cash flow is negative. Now, the MAS for a second property have restrictions on the loan to value. So on a second property, the loan to value is only 45%, and on a third property, it's only 35%, meaning you're going to have to put down a 55% deposit on a second property and a 65% on a third property. So the amount that you can borrow basically goes down significantly. Now, interest rates at the moment are hovering between 3 to 4%. They are lower, but do bear in mind that that is lending to somebody who resides in Singapore on a Singapore property. And so the banks tend to look at that as less risky because the person lives in the same country as they are wishing to borrow and purchase a property in. Now, MAS have also introduced, as I mentioned, the TDSR, the total debt service ratio. And so what this does is reduce the amount that you can borrow. So as a percentage of your total income, you can only borrow up to a certain amount. And even if you have a very large salary, if you have got to the percentage which has maxed out your loan facilities, you won't be able to get any more mortgages. So it does restrict the number of loans that you can get, and in this case, potentially the number of properties in Singapore. But one of the nice things is if you do buy off plan, you can get a mortgage offer before signing the sales and purchase agreement, so you're not taking on mortgage risk. So when we look at any industry, supply demand has a major impact on property prices, in this case, or rental growth. And here what we can see going back to 1994 are the number of net additional dwellings in the UK, how many properties are being delivered, and the net number of increase per annum. Going back to 1994, it was about 150,000. Going up to 2020, that did increase to about 250,000. But it's still fallen way short of what the UK requires to keep up with the supply and demand. While the Conservatives were in, the target was to reach 300,000. And as I mentioned earlier, Labour has targeted 1.5 million over the next 4 years. That equates to 375,000 properties per annum. And we'll see in the next few slides why I think that's going to be very, very challenging. When we look over the last 30 odd years, at no point has any government been able to achieve the targets. The target bar has now been raised, and actually we'll see that probably the supply of properties coming in on the pipeline over the next few years is going to actually go down before it goes up. Now, if we look at the green line here, this is actually showing the number of new planning consents. So developers who are taking on a piece of land and getting planning permission need this before they can actually start doing the actual building works. But if we look over the last few years, as we've come out of COVID with higher interest rates, we've seen that the number of planning consents has actually significantly reduced. Now, why is this important? Because the time frame it takes to find a piece of land, acquire the land, get the planning consent, and then build it can easily be 2, 3, 4 years, depending on the size of the development. So if we know that the number of planning consents has gone down, it means the number of new build developments in the pipeline is reduced, and that's going to have a knock-on effect in the supply in the coming years. This actually shows the construction, and if we focus on the black line, the total new housing or the number of developments in the process of being constructed, we can see some interesting things. Back in the global financial crisis in 2020, we can see that literally the number of buildings being constructed fell off a cliff, and that was basically because of the lockdown, and builders, like in many industries, couldn't go to work, and so buildings halted. It quickly turned around as people went back to work. But again, we can see in the last 3 or 4 years, the overall trend is that the number of new developments being built at the moment is reducing. And again, this is going back to some of the points I mentioned earlier. Developers need to borrow money, interest rates are higher, labor costs are higher, material costs are higher. So a lot of developers have been sitting on the fence, riding out the challenges that have been experienced for developers in the last few years. And as a consequence, the number of properties being built and delivered now and in the next few years looks like it's going to decrease rather than increase. And the reason why I think that it's going to be very challenging for the Labour government to be hitting the targets of 375,000 properties per annum, or 1.5 million over the next 4 years. Now, the next few slides from Singapore is taken from the URA, the Urban Redevelopment Authority, and is the government arm that really controls a lot of what's happening with the land and the land usage in Singapore. And I think one of the things that does significantly differ in Singapore is that the government does control every square foot of land, every piece of land is zoned, and so the government is able to manage the real estate market here. And what they tend to do is make sure that no land is not too much land is released at any one point in time. So they do a good job in trying to maintain a healthy real estate market without creating a bubble. They've also introduced various cooling measures if they feel that the market is overheating and becoming unaffordable for the average person to be able to get onto the property ladder. Now, that said, this is showing the pipeline of private residential property and executive condominiums. If we go to, it's literally up to Q2 of 2024, this is actually showing the number of unsold private residential properties. So in Singapore at the moment, we're looking at just over 21,000 units that are unsold private property units on the market. This is projecting the number of private properties coming on the market over the next 5 years. Now, to put it into context, the average number of private properties that were sold, or rather brought into the market over the last 5 years, the average was about 9,300. We can see that in the year 2024, we are just under 8,000 units. Next year, it looks like we'll be projecting just under 6,000 units. So it does look like, based on the average of 9,300 in the last 5 years, the supply over the next couple of years looks like it's going to be on the lower side. But then by 2026, 2027, it looks like it's going to be picking up. So overall, probably averaging out at what it has been doing over the last 4 or 5 years. Now, looking at the blue line here, this is actually showing, going right back to 1980, the housing price index. And we can see that in the UK, the line is relatively straight. It's not very volatile. It's a very steady market with prices ticking away, typically going in an upwards direction. When we look at the sort of 2007, 2008 timeframe, that's the biggest drop in the UK property market since records began, and that was due to the global financial crisis. And when we look at the yellow line, this is actually showing the interest rates. That's the Bank of England base rate going back to 1980. And we can see that, over the last 2 or 3 years, there has been a significant increase. But we have to look at this in context, because between 2009 and 2021, we had historic low interest rates of below 1%. And as I mentioned, at one point, it even went down to 0.1%. So it was really almost like free money at that time. I remember when I bought my first property in 1997, I was paying 6 or 7% interest rates. And if we go back to the early 1980s, it was closer to 16, 17%. So to put it into context, even though interest rates have gone up significantly, when we look at the last 50 years, they're still actually on a relatively low side. But we can see in the UK that even with the interest rates going up in the last few years, that prices of property have gone up, albeit at a much slower pace. Now, let's contrast this with Singapore. This is the Singapore Private Residential Property Index going back to 1975. So a similar kind of time frame. But the first thing that jumps out to me is the peaks and troughs here, that the Singapore property market actually is far more volatile than the UK property market. And that can be good and bad. If you buy at the right time, then you may well make a very strong capital growth. But if you buy at the wrong time, you could find yourself in negative equity very quickly. Now, I'll give you a personal case. When I arrived in 1995, property prices were obviously looking like they were peaking. And then the Asian currency crisis hit. That had an impact, and we saw property prices plummet within 12 months. And we can see here going on the index from about 135 down to 65. So a drop of like almost 40, 50% in the space of a year. I mean, that's scary. If you had bought at the peak in 95 and then, a year later, your property price had gone down by 40 or 50%, that would have been extremely worrying. Now, towards the end of 1999, what we started to see was property prices picking up. And so I decided to buy just at the beginning of the year 2000, thinking that I was going to be here long term and it was time to get into the property market. And it looked like with prices starting to rise, it was a good time to get in. Little did I know that soon afterwards, property prices would drop by about 20%, and they actually stayed there for about 5 or 6 years. In fact, I was at a point where I was thinking, is the property price ever going to increase and at least get back to the price that I paid for it? I remember having a round of golf with the senior valuation director from Chesterton's at the time, and he actually said to me, Richard, if your property ever gets back to the actual purchase price that you paid for it, sell it. I'm glad I didn't take his advice, because we can see as time went by that property prices have gone up significantly. And when I did sell it, it was in 2013, just before prices started to drop due to some government measures that were brought in. But if we look in the last 4 or 5 years, it is quite astounding that even with interest rate increases, we've seen that property prices have gone up really very strongly in Singapore. So it begs the question, what is fueling these prices going up? And again, this is my interpretation. I'd be very interested to hear your thoughts in the chat box as well. But I think one of the things that happened as we came out of COVID is Singapore came out of it very positively. Many people saw Singapore as a safe haven. People were migrating from places like Hong Kong that were having very strict measures. They were having political challenges. I think wealthy people, let's say from China, wanting to have a safe haven country to move their family, an undersupply of properties. And what we've seen is a phenomenal property price growth rate, to the point where we have seen some additional government cooling measures. So again, it does beg the question, after seeing 4 or 5 years of very strong property price growth in the private residential sector, are we going to see a correction? And based on history, it can happen very quickly and prices can suddenly change very quickly. So again, this is why when I look at Singapore, very often I'll say in the UK, it's not so much timing the market, it's time in the market, because over time, you're going to make money based on historic data. In Singapore, actually timing the market can be extremely important because prices can go up and down very quickly in a short space of time. Now, here we're looking at the rental increase in the last year. So the purple bars are showing the different regions across the UK and the percentage of the increase in the rent year on year. So we can see every region has seen a healthy increase, anywhere from 4 to, when we look at the northeast of England, up to about 9%. Now the orange dot, excuse me, the pink dots are actually showing the increase based on the last 3 months and then annualized as a percentage. And so every part of the UK is still on the rise, although it's slowing down, apart from London, where we've seen the first time in many years the actual rentals starting to drop by 0.3% in the last 3 months. So again, we are seeing as a general trend rentals continuing to increase. And I should say, when we look at what's happened in the rental market across the UK in the last 2 or 3 years, because of the huge undersupply, the fact that many people can't afford a mortgage, they've been forced to rent, we've seen actually very strong rental growth. So anybody who's a landlord in the UK at the moment should definitely have seen an increase in their yield over the last 3 or 4 years. Now here we see the URA private residential rental index going back to 1990. And again, the first thing when I look at this is that there's a lot of peaks and troughs. It can move and change very, very quickly. Again, timing the market can be very important, but it does make me a little bit nervous when I can see that my rent, let's say if we take 1995 to the year 2000, it's going from about 115 on the index down to about 70. So again, rents significantly dropping in the space of a few years. Now, that said, when we look at what's happened in the last 3 or 4 years, it is quite amazing that the rentals have just skyrocketed, going up 50, 60% in the last 3 or 4 years. And again, I'm scratching my head a little bit on why it's gone up so much. We've had interest rates going up, yes, but the owner occupancy rate in Singapore is about 89%. So the vast majority of people living, or at least Singaporeans, own the property. So we tend to find in Singapore, the rental market is primarily driven by foreigners working here in Singapore. And when you see a slide later showing that the stamp duty for a poor old foreigner is now 60%, one can understand that there's really very little option than to rent a property. And if there is an undersupply, then this may be the reason that's contributing to such a strong rental growth. But I do scratch my head a little bit on how it is, because when we look at the vacancy rates, it's not like Singapore has zero vacancies, as we'll see. So Any input and thoughts, please share in the chat box, because it's a little bit of an anomaly to me. And this focuses in on the rental index just over the last 5 years. So again, we can see that there's been very strong growth over the last 3 or 4 years, but we can see that since about this time last year, rents have just started to come down. So are we at a turning point? Maybe so. Now, there isn't a huge amount of data that I can get hold of when it comes to the vacancy rates in the UK. When I was doing my research, preparing for this presentation, I did find several real estate companies, one Cushman and Wakefield, saying that the average vacancy rate across the UK is only 1%, and that London was at 0.89%. So phenomenally low vacancy rates. Now, this data is actually from a property management company called Life Residential. They manage over 4,000 properties across Greater London. And so it does actually represent a fairly good representation of the London property market. Now, in 2020, as COVID kicked in, many people living in central London said, well, I don't need to be paying prime rents. I'm going to stop my lease and move to somewhere on the outskirts of London or in the countryside, because I don't need to go into the office anymore. So there's no point paying premium rents. So out of 4,000 units, we can see at a peak in 2020, there were 209 vacant units, which represents a vacancy rate of about 5% on 4,000 properties. But as people return to work, what we found is that many people who had renegotiated a very attractive lease because rents went down by 25 to 30% across London, locked in and kept those very good leases. There was a limited supply, as we've mentioned before, and so it's become incredibly difficult to be renting property in the UK in recent years. And this has got to the point whereby real estate agencies have been advising clients that if they see a property that they want to rent, they need to make an offer and almost take it the day they do a viewing, sometimes even having to pay 6 to 12 months rent up front in order to get to the top of the pile of people looking to rent. And it's not uncommon that people are having to take temporary accommodation in hotels or serviced apartments whilst waiting to find a property that is at a very high rental cost these days. So again, this is from the URA, and if we focus on the orange line, which is showing the vacancy rate, based on the last quarter, the vacancy rate is in the private property sector at 6.1%. Going back just 12 months, it was at just over 8%. So this is why I scratch my head a little bit, where we've seen rentals absolutely skyrocket, and yet we still got between a 6 to 8% vacancy rate in private property. So whether it's just like a frenzy that has created an artificial bubble in the rental market, I'm not quite sure, because there's certainly what appears to be vacant units out there. We are starting to see the first signs of rentals coming down. So it's going to be interesting to see over the next few years, do they continue to come down? And if so, by how much? Let's move on to stamp duty. So this is the basic stamp duty in the UK, and it's on a sliding scale. And as we can see here, whether you're a foreigner or a local, the basic stamp duty rate is 0% for a property under £250,000, and then increases on a sliding scale depending on the purchase price, going to a maximum of 12% for anything over £1.5 million. Now, there are some additional stamp duties, so that if you're a non-resident, so my guess is for most people on this call, if you are buying a property as a non-resident, which includes myself, there is a flat 2% additional stamp duty. And if that property is going to be rented out as a buy-to-let or investment property, there's an additional 3%. So if we were to take a property, let's say at £100,000, there would be no normal stamp duty, but you would be paying 2% as a non-resident, 3% as a rental property. So you'd be paying a total of 5% on a purchase of £100,000, or roughly, £5,000 of stamp duty. Now, when we compare this with Singapore, BSD is the buyer's stamp duty, or the basic stamp duty that you would pay on a property. And again, it's on a sliding scale going from 1% up to 6%, depending on the price of the property. Now, the next slide shows what we call ABSD, or the additional buyer's stamp duty, which was one of the many cooling measures that the government brought in to try and slow down the price of properties becoming unaffordable to the average person in Singapore. And in April last year, they actually further increased the ABSD. And when we look at this top line, SC is a Singapore citizen buying a second property, then the ABSD has gone from 17% to 20%, and buying a third property is changed from 25 to 30%. So if we took a property, let's say an entry-level condo in Singapore costing 1 million Singapore dollars, it now means that the ABSD alone is 200,000 on the second property and 300,000 on the third property. And if we jump down to the foreigners, I feel very, very sorry for a foreigner that's living in Singapore, or even an overseas foreigner wanting to buy into Singapore, but particularly for foreigners living here, having to pay a 60% stamp duty on the property, which I imagine for many foreigners just means it's not even an option, and hence the reason they're forced to rent, and possibly the reason why the rental market has gone up so strongly in recent years. So, dare I say, if you've fallen asleep, please wake up now, because the next couple of slides is really comparing the figures and numbers and the return on investment of investing into a Singapore condominium and a UK condominium. And what I've done is use some very generic assumptions here, but I think they are fairly realistic. But one could argue to say there might be, some discrepancies here and there. But I think the overall picture that I want to share should come to light as we go through the next couple of slides. So I think it's fair to say that an entry-level one-bedroom condominium in the outskirts of Singapore can quite easily cost $1 million Singapore dollar. If I look in the UK, the entry level for private properties is much cheaper. In this case, I've used an example of £120,000, which at today's exchange rate is about 195,000 Singapore dollars. Now, when we look at the ABSD, I'm referring to a Singaporean now investing in a second property, not your primary residence. We're looking at investing in additional property over and above your primary residence. So for a Singapore citizen, that means they're going to be paying a 20% ABSD plus approximately, through the sliding scale, another roughly 3% on the basic stamp duty. When you do and use an actual stamp duty calculator, the exact amount on $1 million comes to 224,600 in stamp duty. In the UK, I mentioned if it's a property below £250,000, then there's no basic stamp duty. There's just the non-resident and the buy-to-let stamp duty, which comes to a total of 5%, or 9,750 on a 195,000 purchase price. The loan to value on a second property for Singaporean is only 45%, which means you're paying a 55% deposit. So on $1 million, that's $555,000 cash deposit. In addition to your stamp duty, we can see that the total cash required on $1 million property is 774,600. Now, in the UK, there's no restrictions on the loan to value. It's whatever the bank is comfortable to lend. The maximum really is about 80%, but 60, 70, even up to 75% is very achievable. I've used a figure of 70%, so effectively putting a 30% deposit down plus the stamp duty on 195,000 property means that the cash required to buy that property is 68,250. Now, I appreciate I haven't taken into consideration legal costs and other miscellaneous costs, but the bulk of what you need in order to buy a property is the actual deposit and the stamp duty. Now, I'm not going to go through line by line every single figure, but in Singapore, 3% is actually on the fairly generous side as a gross rental yield. 6% is very achievable as a gross rental yield, especially outside of London. And if we look down then at, based on the estimated gross rental, net rental, factoring in the mortgages, the interest rates, the net cash flow that we get on $1 million property is approximately $650 per month of positive cash flow. In the UK, it's 131, but do bear in mind that that property is 195,000, not $1 million. Now, I want you to really focus on the amount of cash that's required. So the numbers where it states for the Singapore property, you're going to need 774,600 of cash to buy one entry-level condominium of $1 million. The entry level in the UK is 195,000, and the cash required based on the loan to value and the stamp duty is just 68,250. So when you take the amount of cash to buy one property and divide it by the individual entry-level property in the UK, so I take 774,600, divide it by 68,250, I get about 11.3. So what that means is with the same amount of cash to buy one entry-level property in Singapore, you could actually be buying 11 entry-level condos in the UK. And I think this is possibly quite a shock to many Singaporeans because they may not be aware that the entry level of a property in the UK is so much lower. And of course, the stamp duty is much lower and the loan to values can be much higher. So looking at the figures here, what I've done is take a situation whereby how much cash is one unit generating for the Singapore property. And as we've mentioned, we've estimated that's at about 650 positive Singapore dollars per month. The individual UK condo was 131 Singapore dollars a month, but let's times that now by 11 gives us 1,441 of positive cash flow. So every month we're making a stronger cash flow from our 11 properties. Now I'm going to make a very sweeping generalization, but let's work and go with this, that we're going to make the assumption that over a 10-year period, properties in both Singapore and the UK double in price. Now, whether that happens, we don't know, but I'm just trying to use an apple for apple that will just assume that both markets double in price over 10 years. Now, without going through line by line, when we look at the estimated capital gain, the amount of positive rental that we make, and then the profit that we have made once selling the property and paying back the bank, gives us an estimated ROI of 141%, or in financial figures, just over $1 million Singapore dollar profit over a 10-year period. In the UK, doing the same thing, we're making just over 2.2 million profit, or a 294% return on investment. Now, one of the big advantages in Singapore is there's no capital gains tax. So the net ROI after tax is still 141%. Now in the UK, if you bought through a company structure, the corporation tax for capital gains is at 19%, so that is going to reduce your net profit, but still shows a net ROI of 239%, which is almost 100% higher than we see in Singapore. So really trying to use some realistic figures, it then begs the question, with my hard-earned cash, should I be investing in Singapore based on the fact that I live here, I know it, and I'm comfortable with it, or if I was to learn and get comfortable with another country like the UK, would it be prudent to invest not necessarily all, but maybe some of my cash to have part of my investment and property portfolio in a country like the UK? And this is really why I like to share this seminar and webinar, so that people can make a more well-informed decision and think of, what shall I do with my cash? If I like property and real estate as an investment asset class, maybe I should consider diversification and looking at somewhere like the UK. Now, this comes to the last slide with the data, so I hope you're hanging in there. I appreciate there's a lot of facts, figures, and numbers, but as I mentioned earlier, I'd like to use data to be able to make educated decisions. Now, when we look at the table here on the far right, what it's actually showing is across the UK, the annual change in property prices. And we can see that they've gone up in every region, not hugely. Northern Ireland did the best at 5.8 price growth. The only region was Eastern England that had a negative annual change. But as I mentioned, even with high interest rates, we've still seen moderate growth across the UK. Now, in this column here, we can actually see the average prices of property across the UK. Not surprisingly, Greater London, the average price of a property there is £536,000. The least expensive is in the northeast of England at £171,000. In fact, I have access to properties right across the UK, and even properties as cheap as £75,000, providing up to 9% net yields. So again, I wanted to show the figures here. So these are actual numbers. The source is the Halifax Building Society lenders in the UK. And these are the average property prices across the region. So again, it may surprise many people on the call tonight that the entry level for properties across the UK is so much cheaper than an average price of a private property here in Singapore. And looking to the left, the clouds and the sunshines, this is a prediction by Savills of the property price growth over the next 5 years. And we can see across the whole of the UK, it's estimated to grow by 21.6%. So, a moderate growth of between 2.5% to about 5% per annum. Something I think is very achievable, very stable, unlikely to be getting a bubble. So again, a very steady property market. The northwest of England, where the Liverpool, Manchester area is again projected to have the highest rates or growth rates at 28.8%. The northeast, which is the Newcastle, Sunderland, 25.2%. So overall, it does look like the projections are showing positive growth over the next few years. So that really brings me to the end of the presentation. I'd really just like to wrap up with some summary points here. So why is it that the ROIs appear to be much stronger in the UK, and why is it that you can buy multiple properties for the same amount as one property here in Singapore? And it really is these following factors. Due to much lower entry-level price points in the UK, higher loan to values and much lower stamp duty, it is possible to acquire 10 to 12 properties for the same amount of cash as one entry-level condo in Singapore. In my opinion, that reduces your risk due to diversifying a portfolio across 11 properties, as opposed to having all of your eggs in one basket. And if you imagine that if the economy does change and you don't have a tenant in your one Singapore property and you're servicing a significant mortgage, then that's pretty risky. If you had 11 properties, if one or two of those properties, for whatever reason, had a vacancy for a few months, you still got 8 or 9 properties that are generating an income, and of course then diversifying your risk. Higher yields in the UK. Again, I mentioned that outside of London, it's quite achievable to be getting a 6% gross yield. Interest-only mortgages mean that the amount that you service each month is much smaller, which gives you a stronger positive cash flow from your property. The potential of the ROI is much greater. Again, I have used very generic assumptions, but I think it shows a very strong argument that the ROI in the UK is potentially much greater. The Bank of England and UK lenders are starting to reduce interest rates. And with this, we are seeing the early signs of buyers returning to the market, together with a huge undersupply, could potentially see strong growth over the next few years. So it's an interesting time to get into the market at the moment. Yes, interest rates are quite high. You could buy an off-plan property, hope that those interest rates come down over the next couple of years. And by the time that you come to actually applying and getting a mortgage offer, potentially those mortgage rates could have come down, but the property prices could have gone up. Now, Labour are going to be doing a mini budget in the end of October. And if anyone watched the news yesterday and today, it's highly anticipated that it's going to be painful. They have said that there are certain taxes that they're not going to increase, but I do suspect that taxes around stamp duty potentially could see an increase. So there's a couple of months before we know exactly what changes to the tax regulations will be. So it does beg the question again, if you've been considering to buy and invest in a property in the UK, it might be worth speeding up that process, because stamp duties potentially could well be going up in the next few months after the mini budget of Labour coming into power recently. So that brings me to the end of the presentation tonight. I hope that you've found that useful. What I would like to encourage is, if you do have any questions, you can put those into the chat box. You should be able to see that towards the bottom right of your screen, depending on how you've got your screen set up. And so I'd like to encourage some questions, because what you may be thinking, other people may be too shy to ask. So please do fire away with your questions, and I will certainly do my very best to answer them. Okay, we've got one or two questions and comments. Will we get these slides later? We will be sending out the recording, so yes is the answer. So we can share the recording with the slides for you. Question here, one of our callers. I live in London. Properties are rented out before the previous tenants move out. Okay, Harsh. Yeah, yeah, I know you're a property owner. Thanks for sharing that. Certainly what we found is that it has become a market at the moment that's so hot that it is extremely difficult for tenants to actually rent a property. And if they don't make up a decision at the time of the viewing, if they wait a day or two, the opportunity has gone. So again, it just shows that there is such a limited supply of rental property, and that's pretty sad if you're a tenant, or it's sad if you're trying to get on the property market and forced to rent. But if you are an investor, it is an extremely good thing, because you have great confidence that there are tenants lining up to rent your property at attractive rental prices. Lawrence, thanks for the question. Hi, Richard. What about buying commercial properties in the UK? Are they better? Interesting question. I have to say that I'm not an expert in commercial property, so I can't really answer that one. Certainly there are differences in stamp duties and certain regulations, but I would need to refer you to somebody who specializes in commercial real estate as opposed to residential. Please keep the questions coming. I do appreciate we've just gone over 9 o'clock. So if people do need to sign off, then again, thank you very much. Something maybe just to round off with is that, if you are considering investing in the UK, I have access to properties all across the UK, whether it be London, Birmingham, Manchester, Liverpool, properties in London ranging from £350,000 to well over £1 million. Places like Birmingham, Manchester, maybe lower end 150 to £200,000. But I do have other properties um, in social housing, government-backed properties, which start from as low as £75,000, giving a 9% net yield. So very, very low entry levels. £75,000 is just over 120,000 Singapore dollars, giving a very, very strong net yield where ultimately the government is paying your rental as well. I even have UK related investments starting from 17,000 Singapore dollars, offering 12 to 17% annualized returns. So I've got a wide variety of real estate related investments. And really what I'd like to encourage is that if you'd like to have a more personalized chat, be more than happy to set up a virtual call. If you're in Singapore, we can meet face to face. And, what I'd like to do is better understand you as a client, what your investment goals are, your risk appetite, your time horizon, and then really assess what would be the best kind of investment. It doesn't have to be one or the other. It can be a portfolio of investments. So it might be investing in multiple different forms of real estate and having a wider portfolio, again, diversifying and reducing risk in that respect. Okay, another one from Lawrence. Will landed properties or apartments make more sense? Okay. If you are an investor investing from overseas, one of the challenges I would say, and I've owned a landed property, it was actually a holiday property in a beautiful part of Devon, with coastal views on 3 sides of the property. It was a stunning location and easy to rent out as a holiday property. But with a full-on garden, managing that property was far more challenging. Both landed properties, detached homes, and apartments can both perform very well. It really depends where you're investing and looking at some of the dynamics of the real estate market, the supply demand, and a variety of other factors. But generally saying, I would say that investing in an apartment, because the common areas are managed by a third party, you're not having to attend to the gardening and these kind of things, and it tends to be easier to own a property and have it managed as an apartment or condominium compared with a landed property. I'm interested if there was any questions on things like mortgages or buying through your personal name or company structure. There are a lot of differences that I shared some headlines on. Now that when it comes to actually mortgage advice, I can't give mortgage advice because it is a regulated activity. But when you've got interest-only mortgages available compared with principal and interest, you've got TDSR things that impact if you take with a local bank compared with taking a loan with a overseas bank. Does present different opportunities. Christopher, question, good. Would you recommend purchasing 6 or more residential properties in one transaction to benefit from a non-resident SDL rates? Interesting question. Could you do this personally, or would it need to be via a company? The answer is yeah. I mean, basically, you potentially can save a lot on the stamp duty by buying effectively a bulk purchase in the same block. I have heard, and it'll be interesting to see what happens in the next mini budget at the end of October. I have heard that might change. So be aware if you are thinking of buying 6 properties or more to benefit from a significant reduction, or buying through that company structure, then it may be worth having a word with a lawyer just to double check on, or a tax consultant, I'd be happy to try and find out for you if you wish, because I have had rumors that that might be changing soon. But you are correct, it is far more beneficial if you're in a position to be buying multiple properties, or 6 or more, in the same block. Thank you very much, everyone, for taking time out of your busy schedules this evening, wherever you are dialing in from. I think most of the people are from Singapore, but we've had 1 or 2 people actually from the UK as well, which is nice to see. Some from Malaysia and Hong Kong. So great to connect with you, and you know, I look forward to having some meaningful conversations over the coming days and weeks. So I think what we'll do is, I don't see any other questions coming in. So again, thank you very, very much, and good night, and let's be in touch. Thank you.